Hello, happy Friday, everyone. My name is Jennifer Camano, and I'm the Planned Giving Director for the Arizona Foundation for Women. It is 12 o'clock, and I just want to give a couple extra moments for those to enter, and then we'll go ahead and get started. Thank you all. If you're just joining us, we're just going to wait another minute or two so some more people can come into the webinar. All right, I'm going to go ahead and get started. Thank you for joining us today for Arizona Foundation for Women's Financial Independence Seminars. Today's topic is Don't Wait, Plan Your Estate, and it will be presented by Mary Ann Henley Favada. Sorry, I saw a little technical thing and I got sidetracked. She's a member of our Professional Advisors Committee, or our PAC. With this series, AFW brings you information from experts in estate and financial planning, elder law, accounting, and philanthropic giving. And they are people who have advice and information who can help you make critical financial decisions that affect you, your business, your family, and your community. We are very grateful for the support of Bivens and Associates Law Firm for sponsoring today's session. Bivens and Associates is your Arizona law firm for estate planning, probate, and trust administration, elder law, and special needs. Our friend Stephanie could not be with us today because her son is graduating. But if you don't mind, I would like to play a video. Oh, wait. Didn't do what I was taught to do today. Okay, here we go.
My name is Stephanie Bivens. I'm a Phoenix native and was fortunate to spend a lot of time with my grandparents growing up. Taking care of family has always been important to me. Bivens and Associates is one of the most experienced and trusted estate planning, probate, trust administration, elder law, and special needs law firms in Arizona. We apply our knowledge, experience, and compassion into everything we do. Whether we are creating an estate plan to protect our client's legacy or helping to administer an estate or trust after a loved one's death, we know what works. We also understand the unique needs of seniors and persons with special needs, and work with our clients to be sure their medical and financial needs are met through the use of guardianship, conservatorship, special needs trusts, and all-tax benefits planning. With over 50 years of combined attorney experience, you can depend on us. Bivens and Associates. We are here to help.
I want to stop sharing and let you know that Stephanie Bivens is also, she's a co-chair of our Professional Advisors Committee, and really remarkable, hardworking, and very generous person. She has a firm that right now is a group of female attorneys, and just really think the world of her. So yeah, next on the docket, 2021 was another devastating year for many women around the globe. There's a continuing childcare crisis, hundreds of new restrictions on women's rights, a She Session where 2.3 million women in the United States alone left the workforce due to the pandemic. During this turmoil, women in Arizona have continued to face daunting circumstances. 2 in 5 women have been the victim of violence at home. 1 in 5 do not have access to healthcare during this global health crisis. 1 in 7 are living in poverty. A crisis affecting women affects all of us. It undermines the strength of our communities. Ensuring Arizona's society and economy work for everyone only happens when we meet the safety, health, and financial needs of women in our state. When a woman controls her safety, she makes her surroundings safer for her children, her parents, and others in the community. When women are healthy and productive, they improve the health of others around them, both as caretakers and in their professional lives. When women earn more, they pay it forward, they pay it backwards and sideways. They help their families, they help their friends, and their communities. And I know it sounds like a generalization, but by and large, it's true. And that's why we say women are the backbone of our society. For more than a decade, the total amount of philanthropic giving to women and girls has remained at a stagnant 1.6% of all philanthropic giving. Despite the scope of the problem, charitable giving to nonprofits dedicated to supporting women and girls increased only a fraction over the past year. The latest report from the Women's Philanthropy Institute shows a marginal 0.06% increase. It's 1.9% of all charitable contributions. So I would like to make a plug that if you, your clients, your family, your friends, they're interested in helping Arizona women, please reach out to me. We accept a multitude of gifts, from real estate to stock to cash. So please get a hold of me. And now it is my pleasure to introduce Marianne Henley Favada. Marianne joined CapTrust in 2020, and she works with client families on a variety of wealth management issues, including investment management and strategic multi-generational planning for high net worth clients. Marianne coordinates closely with her clients' CPAs and attorneys, which we know is very important, to ensure proper implementation of investment, financial, insurance, retirement, tax, and estate planning goals. This is so important to have someone that's connected to all of those others. Marianne serves on the Estate Planning Management Committee, where she focuses on educating staff regarding current estate tax law, informing staff of new pending legislation, consulting with clients, and serving as a local resource for estate planning matters. Marianne came to CapTrust from MRA Associates, where she served as a senior client advisor and as a member of MRA Associates Management Committee. Prior to that, Marianne spent 7 years in the Scottsdale office of Henry & Horn. She also has extensive experience working in the financial business, management, tax, accounting, corporate analysis, banking, and insurance. When Marianne is not involved in holistic wealth management, she's focused on elevating the safety, health, and economic empowerment of women in Arizona. And she's a mother, and her daughter just helped me do certain things. So she's a powerhouse. I love Marianne. She brings a wealth of information, and she's just a generous spirit, and she's funny, that is just a high marks in my book. So drop your questions in the chat. I'm here. I'm going to go on mute, but I'm still here. And it is my pleasure to welcome Marianne. And Marianne, I'm going to pull up your PowerPoint.
Excellent. Jennifer, thank you so much for that lovely introduction. And thank everyone for spending time today to go over something that is extremely important, not only for yourself, but for your family. One of the things that I think of at each year end is, what are the gifts you're going to give to people? You know, right? It's holiday season. And I honestly cannot think of a better gift to give your family than the gift of an updated estate plan. All right. Next page, please, Jennifer. So our goal today is to give you some real life action steps so that You don't just think of estate planning as a big project you're never going to get to. It's something that you can understand and take immediate action to deal with, and then obviously update it periodically. So when people think of estate planning, sometimes it can appear overwhelming. But really, all estate planning is getting a plan together to decide who's going to receive your assets when you pass, what assets they will receive, and how they will receive them. Meaning, will they get them outright, or might they be received in a trust? In order to implement your estate planning, there are legal documents that will need to be addressed, and we're going to go over those. And then the other two key items of estate planning are learning to mitigate taxes. For the most part, I would say the majority of Americans are not subject to estate taxes at this point in time, because the amount that you can pass on to your heirs without estate taxes is currently $11.7 million. So unless you have $11.7 million, your assets would not be subject to estate taxes. But there are other kinds of taxes that we'll discuss as well. And then finally, the purpose of estate planning is to provide for the smooth transition of your business ownership if you have such. Okay, next page, please, Jennifer. All right, so what are the benefits of estate planning? Number one, the biggest benefit is that you control what happens with your assets. When people fail to do their estate planning, what typically happens is that the state in which they reside determines what happens with their assets. So if you die without a will and you have assets that have to go through the probate process, the state intestacy laws will determine who gets your assets, as opposed to you determining how you get your assets. So key benefit, you control what happens. Peace of mind. It lets you rest a little bit easier knowing when you're getting older, and if God forbid something happens to you, that your family is going to be taken care of. And one of the biggest aspects is the ease of which the assets will be transitioned to your family. So if you plan, you can make it rather simple and easy for them to take over the assets. Whereas if you fail to plan, the process can be very lengthy, expensive, and kind of a nightmare. And then finally, we always want to make sure that we don't pay any more taxes than we need to. As I mentioned earlier, the estate tax is 40%, but it's only for people who have assets over $11.7 million. That amount goes up to $12 million in January. So for a married couple, it would be double, 12 and 12, 24 million that you can pass on without estate tax. So for the most part right now, no one, not many people are subject to the estate taxes. However, there could be what they call income taxes based on capital gains if people aren't aware that when someone passes, the tax basis in the assets that they own get what we call a step up to date of death value. So for example, if your parents lived in their home for 30 years and they bought that home for $100,000, and now that home is worth $500,000, there was an unrealized appreciation between the price that they paid for the home, the $100,000, and the value that it's at now, the $500,000. So once they pass, the value of their asset is now stepped up to $500,000, meaning if you and your siblings inherit the house and you turn around and sell it for roughly the same amount, $500,000, there will be no capital gains tax on those assets because the assets were stepped up to the value at your parents' passing. Okay, next page, please. All right, so the other key thing is what is included in my estate. And basically, it's everything you own, right? Starts off with your personal property, your furniture, your cars, your jewelry, any artwork you may own. Real estate, if you're fortunate enough to own a home or investment properties, your investments, your checking account, your savings accounts. It includes your retirement accounts, your IRAs or your 401ks at your company, any business interest you own, and it includes half or 50% of assets that you own jointly. So Arizona is what we call a community property state. So if you're married and you don't have a prenup, basically the assets that you own with your spouse are owned by each of you 50-50. So if you own an asset with your spouse, half of that asset's value would be included in your estate. And so your estate includes all these assets, everything you own. And then once they get that total, they subtract any debt that you have. And so that is basically your estate. It's all the assets minus your debt. Okay, next page, please. So people often ask me, when do I start dealing with an estate plan? My 20-year-old daughter asked me this about a week ago. And she's like, well, I'm young. I have nothing. I don't need it. And I said, no, you're wrong. Because in reality, two things. Number one, if God forbid she passed without making a plan, then she would not be deciding who gets her assets. The state of Arizona would decide who gets her assets. And my thought is if something happened to her, she'd probably prefer that her assets go to her sister versus coming to her parents, right? So even someone young should have an estate plan in effect. And the other thing is, if something happens to you medically, you want to have someone that you trust who's going to make decisions for you. And sometimes the people that you would think might be good might not be good. For example, I'm really not good with medical information. Like I'm not good with trauma and blood and stuff like that. So but my daughter is much better. She's much level-headed. So long story short, you want to be the one to pick who's going to be making these decisions for you. So long story short, don't procrastinate. All right.
I want to add something there if I can, Marianne.
Yeah.
It is such a good idea, and you're absolutely right about that. And there are, I specifically, for example, don't want my daughters making my healthcare decisions because I think that would be too difficult for them. I don't have a spouse, so that's another part of it, right? I think it'd be too hard for them to make decisions around my healthcare, so I chose a cousin.
Excellent, excellent decision. I actually have a client who kind of did the same thing, but he didn't want his wife or his daughter to make those decisions. He thought it would be too difficult for them. And so he chose his doctor that he's had for 50 years, who he trusts explicitly, right? So yeah, it's very important to pick somebody that you believe would be able to carry out your wishes, because even though I might be great at finances, I may not be the best one at the medical, right? Okay, next page, please. All right, so there's really only a few ways that assets pass upon your death. So we're going to go through those, and then you'll kind of understand how your assets will pass and what you need to do. All right. So some assets pass by your will. Some assets pass by what they call function of law, and other assets pass by title. Can you go back one page? I think you skipped a page. There you go. Thank you. Okay, so we're going to start off with.
Sorry about that.
No worries, no worries. So we're going to start off with the assets that pass by function of law or account titling. So you'll see over on the left, if you own something by yourself only, sole ownership, or said differently, if it's an individual account, that asset will pass according to your will if you have one. And if you choose not to have a will, the state that you live in will decide. So state law will decide how your assets pass. However, if you have accounts titled in joint tenancy with right of survivorship, the rule of law function of that titling will transfer the assets upon your death to the joint owner. So if you have an account joint with your spouse, when you pass, it does not have to go through probate or hassles. It simply will go to your surviving spouse. Tenancy in common. It's not something you see too often, but usually you see it if maybe there are 3 siblings that own something together, and they all each own a third, a third, a third. That type of ownership would go according to your will or to state law if you don't have a will. And then this last one, transfer on death or pay on death, is a very simple solution to avoid probate if, like Jennifer mentioned, if she's not married and you have someone who has an individual account, and at their passing, it's not going to pass by function of law to a joint owner. So then that normally would have to go through the will and the probate process if you have a will. But there is a designation that you can add to an individual account, and it's like a beneficiary designation. It's called transfer on death, TOD, or pay on death, POD. And that eliminates that whole hassle for your family, and it would go to whoever you designate as your beneficiary. Okay, next page, please.
I don't know why there's a delay. It's so weird.
Yeah.
Bear with me. There.
All right, there we go.
Okay.
All right. So the other key way that assets transfer is by a beneficiary designation. So this covers a lot of assets. If you have IRA accounts, whether they're a Roth IRA or a regular IRA contributory or a rollover IRA, whatever form of IRA, you have the ability to fill out a beneficiary designation form on that account to designate who you want as your beneficiary. And there are two types. There's the primary beneficiary, who's your first choice. And then there's the secondary beneficiary, or also known as the contingent beneficiary, which would be the person or persons to get the money if, God forbid, the primary beneficiary was not around at the time of your passing. So your IRAs pass that way, your company retirement plans pass that way. If you have a 401k, if you're a teacher, you might have a 403b or a 457 plan. There aren't too many pensions left these days, but there are some. So if you're fortunate enough to have a pension, those assets too would pass by a valid beneficiary designation. Annuities and life insurance. And I mentioned the word valid. And the reason I mention that is a lot of times people think that they have these designations on file. And it is possible that you filled out the form and you thought the form was on file, but stuff happens. And if that form was filled out 20 years ago and computer systems were updated and sometimes companies merge, and maybe, you know, one insurance company merged with another insurance company and their records could get a little skewed. There could be times when those beneficiary designations are not what we perceive them to be. So I would encourage you to make sure that what you think is on record with each of these assets is truly what's on record.
I want to just add to that, that this happened in my very own family where it was mentioned one way in the will, but with the pension place, it was not updated. And so it went to, this is a shame, but it went to one party instead of maybe the one she had intended it, because she changed it in the will, but not on the employer side, the
Right.
actual beneficiary. So my goodness.
Yeah, and that I cannot tell you how many times that happens. I have seen people who have life insurance, they purchased it when their kids were 3 years old, and 25 years later, the life insurance policy is all paid up. They haven't looked at it in decades, and the beneficiary is their first wife, and they're remarried. And it should be the second one. So yes, these are things that even though you may think you know where it goes, you really need to go the extra step and double check and verify that what you believe is true is true. Okay, next page, please. All right, there's one more we missed. Page 8. Okay, so assets pass by function of law on asset titling. They pass by beneficiary designation. And then the worst way they pass is by will or probate. Okay, so our goal is to avoid probate if we can, and to figure out solutions to avoid that legal process and expense and basically nightmare for your family. Okay, so the will is for assets that don't pass by the beneficiary designation or the type of ownership. And so probate is the court procedure for validating. You have to show the will and they have to verify that it was properly executed and it's valid, and then they will start the process of taking assets that are in your name because you're deceased now and that doesn't exist anymore, and transferring it to the people you wanted it to go to. So probatable assets are assets that are in your name individually, assets that you own as a tenant in common, and assets that could have passed by a beneficiary designation, but you didn't update it. So now they have to pass by probate. So I'll give you an example. My company merged into another company last year. And so they transferred my 401k at Schwab to my IRA rollover at Fidelity. So when those assets transferred, my HR person told me, oh, don't worry, all the information they had before is going to move over. But honestly, I knew better. So I checked with Fidelity and I had no beneficiary designation on file because basically it's a new account, right? So I had to go online and fill out my beneficiary designation for my old 401k money that was transferred to an IRA rollover. And then now I have a new 401k with my new company. And again, I had to update my beneficiaries on that account as well. All right, so the assets on the right-hand side of this page that avoid or are non-probate assets, non-hassle assets, are assets like a joint account that automatically passes to the surviving owner, and then the life insurance, annuities, or retirement plans with a valid beneficiary designation. And then one of the best tricks that I advise most of my clients is if they have an individual account and they don't want to add someone to the account, right? Because if you add someone to the account, they can take out money now, right? But if your goal is not to share the money with them now, but to avoid the probate hassle later, you can simply ask the bank or the brokerage house, can I get one of your transfer on death or pay on death designations? And then you list who you want to get your assets, the first one, and then the contingent or the backup person. Okay, next page, please. All right, so I know we've talked about a lot. This is kind of wrapping it up, and then we're going to go into kind of a case study. Okay, so we mentioned the will, and that's the probate, and hopefully you never have to use it, but you want to have it if you need it. But the other typical estate planning documents that most people need are powers of attorney. And there's two basic kinds. There's the financial power of attorney, and that is called a durable power of attorney. And then there's the medical power of attorney. And there's also something called a living will. And we don't want to confuse that living will with your last will and testament, because they're totally, completely different things. The living will is quite often combined with the medical power of attorney. And so some attorneys have two documents for it. Some attorneys combine the two into one. And so the difference is the living will is what I like to call the pull the plug instructions, right? These are the instructions that you want to make clear in the event that you are in a terrible situation and there's really no hope of you recovering, right? And so instead of being kept alive when maybe your brain is no longer functioning or there's no hope of you really recovering again, then you can say, well, keep me medicated so I don't feel pain, but just let me go. So that's pull the plug is the living will, often combined with the medical power of attorney, and the other is the financial power of attorney. And as Jennifer mentioned earlier, the people you put in charge of this may be different. You may have one child who's very good with finances, and you may have another child that is very good with medical situations. Or said differently, you may have family members or trusted friends that you might think would be better to handle one or the other. The last thing I'll point out on this page is that these can start either immediately once you sign them, or they can come into effect when you become incapacitated. So I usually recommend that people list their powers of attorney as immediately effective, because if they're what we call springing powers of attorney and they don't come into effect until you're mentally incapacitated, it's really going to be a hassle for your family to have to go to the doctors and get you declared mentally incompetent to be able to act. But just know that there are two different kinds, and one would allow them to act now, even like if you go to Europe for 2 months and you need someone to handle your finances in the middle, that would allow them if it was an immediate power of attorney. Okay, next page, please. All right, so last item, and then we're going to go into a case study. So the last item are trusts. And a lot of times this is very confusing to people. And as you'll see, you know, most people, when they do their estate planning, don't create trust. And the reason is they don't feel they have a need for it. And it's, you know, expensive to get legal documents drafted and then update them. But there are two key reasons that I typically recommend people get trusts. And one of them is if you are a single parent and you have minor children, right? You can't leave your money outright to a 5-year-old. So you would want to create a separate legal entity that would own all of your assets upon your passing. And then you would pick someone who would be the person administering those assets. So maybe you leave your sister in charge. And so all those assets are in a bucket of money inside a trust for your kids, but your sister's the one who's going to manage the money while they are minors. Okay, so that's a typical trust. And so most people who set up revocable living trusts, you can change them up until you die, right? So if you set it up when you're 30 and your kids are 2 years old and your kids are now 25 years old, you can update it and change it again. It's not set in stone until you die. And then once you die, the trust that was once revocable becomes irrevocable and your wishes are set in stone. Okay, so so now if you could go to the next page.
Yeah, we have a question. I was wondering, I didn't open the chat, but I asked Megan, and I want to go up to the other slide. I think the question was about this. Would you need all three? So I guess the durable power of attorney and medical durable power of attorney. And, you know, I guess I had all three. Like I have a living will and my medical power of attorney in one document. So it's 2 documents, but it is all 3. Do you care to comment on that, please?
You do basically need, I would say you need 2. You need the financial one and the medical one. And depending upon your attorney, the medical one may be 2 forms, but they're both basically covering medical, and then one is for financial. Now, you know, if you have, and we're going to go through a case study, if all of your assets are titled in such a way that you or either have a beneficiary listed or you have another joint tenant, then you may not need the financial power of attorney, right? But you definitely want the medical power of attorney, because if, you know, COVID taught us anything, it's that, you know, even young people can become, you know, ill and pass away in a very short period of time. And so you definitely want to have somebody that you trust who is there and able to carry out your wishes if, God forbid, the worst case scenario happens.
Well, yeah, and wouldn't you have some bills? Doesn't that person also they pay your bills? Well,
Yes, and we're going to go through that in the
okay.
next couple of pages. But yes, Jennifer, that is one of the biggest first problems that people encounter. Somebody dies, and now how do we pay the bills? They don't know the password to the bank account. So that's definitely one of the biggest things that has to be addressed. Yeah.
All right. Are we on the right sheet? Or-
Yes, we're on the right
Okay.
sheet. Okay, so the goal of the seminar today is to create a plan that you can put into action right now. We're going to create what they call a balance sheet or a financial statement, and we're going to go through, and I hope you do this too at home. You're going to make a list of all the assets that you own, whether it's a checking or a savings or a brokerage account or a retirement account. We're going to put your house on there if you're fortunate enough to have one, and we're going to list your life insurance. And then the last item before we get into this sample is personal property. This is something that is important to address if you have treasured items. And I'll give you two examples. One is your wedding ring, right? So you might have two children, and maybe one's a girl and one's a boy. And your daughter may have always loved your wedding ring, and when you take it off to shower, she plays with it and loves to look at it and imagine someday she's going to be married, right? And she loves your wedding ring, and you want that wedding ring to stay in the family. So you should make a list of who you want to get that wedding ring, because if you don't make a list, your daughter and your son, assuming your husband's passed or you're divorced, they could be fighting over it. And maybe your daughter is still single, and maybe your son is getting engaged, and he might want to take that wedding ring and give it to his fiance, right? So it's important that if you have certain items that are treasured family items, that you discuss with your family, and all you have to do is write a little note and keep it with your will and say, I want my daughter to have my wedding ring, because if my son gets divorced, I don't want his wife to keep my wedding ring. Okay, and in my family, we have every holiday I have to hear about grandma's china that went to my father's second wife, because the presumption for personal assets, if you don't make a list and make it clear what your goals are, is if you are married, your personal property by default will go to your spouse. So our family china from grandma went to my father's second wife. Okay. Next page, please. All right. So here's an example of what I hope you will do, which is create a list. Now, obviously, I typed this up. You can handwrite it or, put it in a Word document, whatever's easiest for you. But it's something you want to keep updated once a year if it's possible. So you see on the top, I listed checking accounts, and I listed how the title to those checking accounts are held. So the very first one is saying the checking is at Chase, so you know where the checking is. And it says that, so I use Jane Doe as my person who's passing away here. And you notice that the title of the account is Jane and her husband, Joe, tenants with rights of survivorship, meaning when Jane passes, the asset automatically goes to her husband. The next one you'll notice is Jane owns that checking account individually. So her husband's not on there. And there might be reasons when you're married that you don't want your husband on an account. There could be 100 reasons, but one of the major reasons is if you inherited money. Okay, so say your parent died and left you money, you want to keep that money separate, indicating that's your money, not our money. Because if God forbid you got divorced, if you kept the assets separate, then you don't have to split it with your ex-spouse when you get divorced. But if you do what they call commingle it and take that inherited money and stick it in the joint account, then you have transmuted it and you would have to split that money with your ex in the event of divorce. Okay, so Jane was smart here and she put a transfer on death designation on that account. So when she passes, it will go to her husband and then to her kids, if God forbid she and her husband died together. Next section are investment assets. So if you have, the first one is a Schwab IRA rollover account. Again, you see the importance of documenting who are the beneficiaries. And again, you have a primary and a contingent. Primary gets it first, contingent gets it in the event the primary is not around. In these instances, you see that the primary gets it 100%, but that doesn't have to be. You could have primary 50-50, your brother and sister, and then your uncle as contingent or your girlfriend. But again, make sure that the designation you think is on file is actually what is on file. The next one, again, another IRA with a beneficiary designation to the husband, but you notice in this case, the contingent or the backup person is her sister, Linda. Again, you can give different assets to different people and you don't have to go through a big hassle if you plan your beneficiary designations properly. The next one is an investment account. This is, may have been inherited assets that she wanted to keep separate in case something happened and they got divorced, but she also doesn't want it to go through probate. So it's owned individually, but she put the TOD, transfer on death designation, to avoid having to go through probate. The next asset is a pension plan. Again, most people don't have pensions, but if you're fortunate enough to have that, you want to verify the beneficiary there. The next one is the house, right? So this Phoenix home on Palm Tree Lane, it indicates its own in joint tenant with rights of survivor with the husband. No problem at death. Her name would come off and he would remain the sole individual owner of that asset after her passing. But remember, then you could have a problem at Joe's passing if he doesn't do something. So there's something called a beneficiary deed, which is sort of like the pay on death designation. So after one of the two spouses passes, once an asset is owned individually, if you want to avoid probate and the attorney's fees and the court hassles, you can get a beneficiary deed and say, when I die, give it to XYZ in whatever percentages you want. Okay, so there's all your assets. And then, as I mentioned at the very beginning, your estate includes all your assets, but then there's a reduction for any debts that you owe. And then the $581,000 is the net value of the estate. And you'll notice there's two items left on the bottom. And those are what we call contingent assets. So there are different types of life insurance. Some are what we call permanent life insurance, and they can have a cash value to them. But often people purchase term life insurance, which is much cheaper. And so it doesn't have like a cash value to it, but it does have a value if, God forbid, you die, right? But it has a value maybe not to you, but to your heirs. So this is one of the biggest things that I see, sadly, squandered assets that don't go to the right beneficiaries because people don't know that these assets are out there waiting for them. And so what happens is after a certain amount of time, when assets are not claimed, the states have a rule, and some places it's 7 years, some places it's 10 years. Each state has its own law. But the assets then become what they call escheated to the state. So if you had a life insurance policy and your heirs never knew you had it, and then you died, 10, 20 years ago, then eventually the insurance company is going to say, well, I don't know what happened. No one ever claimed this money. I'm going to give the money to the state. So it's really a sin if you don't keep these asset listings together, because your heirs could be missing out on assets that they really are entitled to. And one of the biggest is not only the insurance that you buy yourself individually, but your employer provided insurance. A lot of employers give you maybe 1 times your salary in life insurance. But again, if your heirs are kids that live 5 states away and they don't know that, they may not know to claim that benefit. So again, get a list together, handwrite it, whatever's easiest, put it in a little box, put it in a box with your will and your powers of attorney. I have mine in a box with a little letter. And I wrote the letter and said, if you're reading this letter, it's probably not good and I'm gone. But I want you to go ahead and cry and get your grief out. It's normal, but I want you to take care of your dad because I know he's going to be a basket case, and then I go through what Jennifer mentioned, which is, here's the list of all the assets and how you access them. I have copies, the most recent copy. Every year I get a copy of my life insurance and I put the most recent copy in the book. And I gave explicit instructions on here's the bank account, here's my sign-in and password. All the bills are set up to be automatically debited except X, Y, and Z. So every month you have to make sure that you pay X, Y, and Z, right?
Wow.
And that kind of stuff. So
we have a question.
Okay.
If you have a beneficiary listed on your accounts, do you need to do a transfer on death?
If you have a beneficiary designation, meaning on an IRA account or a pension or a retirement account, then no, then a transfer on death is not an option. Transfer on death or pay on death is the best option to avoid probate on individual accounts. So when you own it in your name only, those are the accounts that you want to avoid probate and put your own designation, which is the pay on death or transfer on death.
Okay, and I didn't know that a checking account can be held as joint tenants with rights of survivorship. I thought that was just for, I don't know, like deeds to a house, or I didn't know you could do that with a checking account.
Yeah, you can. And that is something that quite often parents do when they get older. They may add one of their kids onto the account so that when they die, the kid can automatically take over the account. But again, you want to be careful that you trust that kid, right? Because if that kid is has a lot of
Yes.
financial problems, they might be siphoning off money.
Oh, I can think of all sorts of things. I know there's bank accounts should do a transfer on death is the question. Your bank accounts, you should do a transfer on death. Patricia, the way I understand it is only if you own them individually.
Right,
Right?
right. If it's a joint account, you can't put a transfer on death on it. Only individual accounts. Okay. Next page, please.
Yes.
All right. So in summary, I hope this helped. I hope I wasn't too confusing. And my goal is always to put things in English simplified language, but the basic things you need to get your estate plan in order is create your list of assets, keep it updated, get a cute little box and put all your stuff in there. Do your legal documents. There's 3 that you need. It's your will, your last will and testament is your will, and then I call it a DPOA, which is a durable power of attorney, is the financial power. And then the next one is the healthcare, HCPOA, that is the medical power. And that's the one that's usually combined with the living will. So 3 documents you got to get. And again, if it's a good idea, maybe a trust, if you have minor children and you don't have a spouse.
I would also add that you need to tell a few people where these documents are and who your attorney is.
Yes, go to the next page. Okay, so doing all the right things is phenomenal. Okay, you'd be ahead of 50% of the population in America. Most people don't have these plans in place. Okay, and I deal with their families every day, and it's sad because it's the old stitch in time could have saved 9 routine. But if you take action, you get your list together, you get your little box, you get your legal documents, you put them in there. The next important thing is you have to communicate your plan, right? Because if you do all this and no one knows where it is, it's useless. So talk to the people that you trust who are going to be the ones who carry out your wishes. Let them know where your documents are located. If you've got minor children and you want to have your sister raise them, and God forbid you and your husband pass in a car accident, make sure that you asked your sister if she is comfortable raising your kids, because it could be a big issue depending on how many kids you have and how many kids she has, and if she's on her first husband or her second husband. So you want to make sure that the people you're entrusting are comfortable with what you're asking of them. And then make sure that the people you put in charge of your medical and end of life decisions are capable of really bearing that burden, because it's very difficult to do.
Hey,
Another
Mary Ann,
thing, yeah,
we're right at 1 o'clock, so I don't know how many slides are left, and I didn't realize.
this is it. This is the last.
Oh, good. Okay, that's all.
One more minute. So another important thing, let people know if you want a funeral or if you just want to be cremated. It's a good idea to discuss organ donation if you're interested in it, so they know. As Jennifer mentioned, you want to provide them with contact information for your employer so they can get your life insurance, for your family and friends that you want to be notified, and for your professional advisors as well. And then finally, review the documents with them, your financial statements, so they know where to collect the monies. Discuss your bank account and how your bills are paid, so you don't have a problem with your mortgage not getting paid. And then discuss getting them access to your accounts, whether you put them on the account or you give them a power of attorney on the account. Okay, so that's it in a nutshell.
So I'm just thinking, I'm gonna stop share. Well, maybe I shouldn't stop share. I wanted to mention that powers of attorney go away once you die, right? So you need to also have, and it could be the same person, but you need to have a personal representative too.
Well, the personal representative is set up in your will. But again, if you took the right action before, and say you put a pay on death designation to the
Yes.
account, then you don't have to get everybody involved. It'll automatically go to your sister and she can pay the bills,
Ugh.
right?
There's
Or
still
if
some
you-
things I have to do. I'm realizing, thank you so much for this discussion. I'm seeing that like I haven't made instructions around what bills need to be paid or how to log on to accounts. It's a lot of
Yeah.
work.
It is, but really it's the best gift you can give your family, because they're going to be so devastated when you're gone. The last thing they need to do is start fighting over, well, I want her buried and I want to cremate it and I want to spread her ashes in Europe, or, if you have these difficult discussions, it's going to make it much easier for the ones left behind. Best Christmas gift ever.
Yeah, no, I don't disagree at all, because I have seen what it does to families. And I bet a lot of people on this call have seen what it does to families when there isn't something written. So I'm going to stop share. And thank you so much. That was fun. And I tried to interject a little to keep it lively so you weren't just sitting there talking to yourself.
Thank you.
I got a lot out of it and I really appreciate it. I just want to check this chat. Oh, good. Phenomenal job. Thanks, Patricia. All right, y'all. Have a wonderful, please, Marianne, we have an email that we can put out, your email, in case anyone has
Questions, feel free to
questions or
contact me. Yeah,
or they need help with their estate.
definitely. Always glad to help.
All right.
And then remember, it's end of year. Good time to do some donations. Arizona offers some tax credits, so you can actually donate money and it's not really going to cost you anything. It's a way of utilizing the money that you pay in income tax and just designating it to a charity instead of to the government. And as always, if you're interested, Jennifer has information on how to donate to the Foundation for Women, because they can always use it.
Yes, we can. All right, everyone, have a wonderful holiday season, whatever you celebrate, and blessings to all of you. Thank you, Marianne. It was a pleasure.
Thank you. Bye-bye.
Bye.